Thanks for attending. We got Paulo Lupescu on the line, and I appreciate you joining us, Paulo, this morning.
It's great to be here. Thanks for inviting me again.
You bet. Well, wanted to really just share, really the quarter has been a wild quarter, and this year's been an interesting year. And really appreciate you coming on. I know we've had great feedback from our attendees and clients, and this gets viewed even after this seminar. And just have a lot of great comments on how you simplify these topics for us, and we really appreciate that. Just to help, keep us all emotions in check, and help dissect the media headlines. So with that, I really do appreciate it. What I'd like to start off with is maybe a little bit about the market review. Whether it's quarter or year to date type of thing, just to kind of get everybody up to speed on what is the market, looking like through June 30 or something like that.
Yeah, and it is interesting because as you said, there was a lot that happened this year. I mean, if you go back to January, that we actually went into Venezuela and we took the leader and brought him to the U.S. And then we had the war in the Middle East. We had consequential decisions from the Supreme Court. There's so much that happened. Now the war in Iran and all this stuff. So the question is, how did the market react to all of this? What's interesting is that if you go to the first quarter, we're actually down about 4.3%. So when we met last, it was not an upbeat quarter because investors lost money in the S&P 500, which is a broad measure of the U.S. market. And I think it's so interesting, Jared, because if we go back to 2025, we had the exact same performance for the first quarter of 2025, negative 4.3%. And last year we had second, third, and fourth quarter positive. So the market for the year 2025 ended up really in nice positive performance. In fact, well above the long-term average. So despite having the first quarter negative in 2025, the rest of the year turned out to be really, really good for investors. And this year, we got to see a bit of a similar pattern because we had the first quarter being negative. Second quarter was significantly positive. So we made up for the losses in the first quarter. And in fact, we are ahead. Through the end of June, a couple of weeks ago, the U.S. stock market is up about 10.2%. And what I find interesting is that if you look at the history of the U.S. stock market, the average long-term performance per year is 10%. So we got that annual performance in half a year. So really a fantastic 6 months. Despite all the anxiety, despite all the noise, it was a really good year for the markets. And when we talk about the markets, I do want to take a step back because I've gotten this question lately. Well, what did well? Is there a pattern that you can identify? And the first thing you can look is say, well, listen, the performance of 10.2 was generated by 500 individual stocks. And if you take a bit of a deeper look, what you see is that 62% of them, so roughly about 300 stocks out of the S&P 500 went up in value. You made money on them, but the other rest, about 200 stocks, you lost money. They went down in value. So not every stock went up or every stock went down. And in fact, if you take a bit of a deeper look at what went in the positive or category, it just shows you how the market is driven by individual companies than rather than sectors. And just to illustrate, I mean, if you look at Bank of America and Wells Fargo, they're both great big American banks. Wells Fargo was in the negative column. Bank of America was positive. You look at Verizon and T-Mobile, great cell companies. Verizon was positive. T-Mobile was negative. You look at Home Depot and Lowe's. They're both home improvement stores. Home Depot was in the positive category. Lowe's was in the negative. And Jared, probably the ultimate is Coke versus Pepsi. Coke was positive, Pepsi negative. So I don't know that the market is driven by beverages or home improvement stores. No, it's a company by company. And then you can take a bit of a deeper look, not only at what positive and negative, but by how much did these companies go up or down? And I think this is fascinating because if you look at the S&P for the first 6 months, there were 94 different stocks that had performance between 10 and 20%. So they went up in value 10 to 20%. That's 94 out of 500. There were another 80 companies that went up in value between 0 and 10%. So, the majority in a way, I mean, not majority, about a third of the entire performance of the S&P was in the range of 0 to 20%. 174 different stocks in that 0 to 20%. And what's interesting about measuring market performance is that the more you go to extreme numbers, extreme performance, the fewer and fewer of those stocks that realize those performance numbers.
Apollo,
If
can I stop you? I think you're showing your screen. We're not seeing your screen.
it basically it's basically you missed the show. Let's see if I can do it again because it said that it's sharing screen. Oh, um it basically said that it's having trouble sharing the screen. So let's try it again. Uh, can you see it
Well,
now?
I can. You're
You,
saying it great, and I could definitely understand what you're saying.
but
But yeah,
it's right now it's not visible.
I can see it now. So you're doing well.
Okay, so what I want to show folks is really what happened for the first quarter, that we had negative and then positive, and ultimately for the first 6 months it was a 10%, with this split between positive and negative. But we also talked about this, how extreme the outcomes can be, and for the first 6 months there were 16 stocks in the S&P 500 that lost more than 40% of their value. And it is interesting that there were some software stocks like you had Intuit, the maker of TurboTax, Adobe makes Photoshop, but there were also other stocks that weren't exactly on the list. Lululemon, the clothing company, lost about 40% of its value. Leidos, the company that makes security devices for the airports, it lost quite a bit of value. So these stocks were negative, but I think the great news for the first 6 months is that on the extreme positive side, there were 48 different stocks that went up in value over 40%. The best performing stock, which is so interesting, is that it's a company that I know from the days when I had a digital camera and I would pop a memory card in it so I can take pictures. And the company that I used to buy from it is called SanDisk. And SanDisk, it was the best performing stock and for the first 6 months. And think about this: the S&P, the U.S. stock market, was up 10%. That's the performance, which you consider to be a good performance. Well, it turns out that SanDisk, the best performing stock in the S&P for the first 6 months, went up more. And I encourage you to put a number in your head. What do you think, just as a random guess, the performance was for SanDisk? Because the actual performance was over 850% growth. 850% growth in this particular company. You had Intel, the chip maker, went up about 275%, and not long ago was left for dead. But it wasn't all chips and AI related. You had companies Accenture that went up. You had companies like Moderna, the vaccine maker. It was up 135%, and even DaVita, the dialysis center, was up 95%. So it was a combination of companies ultimately that generated this great market return that we had for the first 6 months. And the point here is that when somebody's trying to explain that there is one sector or another, it's much more complicated. It's much more company by company, and ultimately the way that we get from these 500 different company results to a single number is that we not only average them simply by adding the performance and divided by 500, but to measure the market performance, you pay attention to the size of the company. How meaningful is the value of that company in the U.S. market and the U.S. economy? And in that respect, these magnificent seven that are so associated with AI and technology, they're not only important because of that reason, but also because they are some of the largest stocks in the U.S. market. And because they're so big, their performance tends to have a much greater impact than DaVita or SanDisk or some other company. And that's why we kind of set them aside and look at them a little bit separately. And remember, for the first quarter, the S&P was down about 4%. These Max 7, these great technology stocks, were down significantly more, 11.3%. And for the second quarter, they rebounded and they were up about 12.8%. So through mid-year, when you combine these two quarters, they were pretty much flat. There's nothing there, just like that. These magnificent seven did nothing for your returns. They didn't lose money, they didn't make money, pretty much flat. Now they left a hole in the S&P. So if you look at the rest of the market, the S&P 500 minus the 7, let's call it the S&P 493. What's really remarkable is that the rest of the market, excluding the Max 7, did really well. Really, really well. To the point is that if you look at without the Max 7, 15.6%, you add these 7 stocks only, and it performance drops from 15 to 10.2%. So the Magnificent Seven for the first 6 months were quite a bit detracting performance from investors. They didn't add, in fact, they detracted because the rest of the stocks did significantly better than they did. And the reason for that, as we talked in the past, is that these Magnificent Seven, they are about 32% of the value of the S&P. So about a third of the performance of the S&P comes from these Magnificent Seven. And as we mentioned in the past, they're also part of the of Nasdaq, which is a different market metric. But because Nasdaq doesn't have a lot of the other big stocks in the S&P, the percentage of these Max 7 is a whopping 47%, so significantly more. And I think this is fascinating because if you look on the news and say how did Nasdaq do, which is what the media reports, well, about half its performance is driven by 7 companies.
Mhm.
The way that McMill and I think modern investors and consultants build portfolios, they're not only looking at the U.S., but they have a global perspective to investing. And if you had that global perspective, you would include the U.S. stocks, including the Max 7. But because you're spreading your bets so much around the world, and you have maybe another 10,000 different stocks as part of your portfolio, the percentage allocated to these Max 7 will be lower, in the neighborhood of about 18%. And there's some really important lessons just looking at these numbers. And the first lesson is that, for the first 6 months, a portfolio that was not too concentrated in the Max 7, like these worlds, like a world allocation, outperformed the S&P. So a global portfolio outperformed the U.S. market because it wasn't as heavily concentrated. So that's one reason, that the lack of concentration that led to better results in the world allocation. The second reason that you saw this is that if you look at the U.S. stock market, you have two different components here. You have the large companies, and that's the S&P 500, and that was up about 10% or so, roughly speaking, if you look at the S&P index. But there are also smaller companies that are not part of the S&P. And that global allocation also has these smaller companies. And it turns out that for the first 6 months, these smaller stocks that we typically, you don't hear so much on the news. So think of large company as McDonald's. Think of small companies as Shake Shack. They're both burger chains. It's just that one perhaps has more room to grow and double in size easier. The other one is probably more robust. So there are different economics between large and small. And for the first 6 months, if you look at the Russell 2000 index, which is a measure of the small caps, it was up at least twice as much. It was about 23% up for the first 6 months. So small caps helped even more. So not only did the S&P did well, but small caps did even better. And to the degree that you were allocated to small caps, and I know that McMill does have exposure for different clients in different situations to small cap, that was an additional benefit that you saw for the first 6 months. And within large and small, we can also delineate through what we call value growth, which means what price do you pay to own something. And in the case of value, once again, over the long run, we see that value typically beats growth, and so was the case this year. I think it was about 16% for large value and about 24% or so for for small value. So really great results that had added to that benefit of not being too concentrated in the Max 7. And on top of that, there's also a benefit from being globally diversified. And I'm going to kind of touch on something that I find quite interesting because there is this idea of AI and the U.S. dominating AI, and it's absolutely true. We're dominating in so many ways in AI. It's just that there's a global value chain, and I find it so interesting to look at that because if you look at the U.S., we have NVIDIA, and NVIDIA is an amazing company because it does these designs for chips that are so advanced, and it's fantastic. Think of NVIDIA as a baker who came up with the recipe for the best cookie in the world. That's what we have with NVIDIA, the best design for chips. Now, NVIDIA doesn't have a kitchen. That baker doesn't have a kitchen. In other words, NVIDIA has no manufacturing facilities. And in order to manufacture their most advanced chips, it turns out there's one single company in the entire world that can manufacture those, not two, just a single company. And that is an investment in an emerging markets country, and that company is called Taiwan Semiconductor Manufacturing Corporation. And then in that kitchen, there's an incredibly specialized oven. On the factory floor at TSMC, there's a machine that is almost science fiction in its precision. If they shot a laser beam from Nebraska to the moon, it would hit a ping pong ball. It's that precise. And there's only one company in the entire world that makes it, which is an investment in the Netherlands, and that company is called ASML. And so if you think about this, there's a global value chain in AI, and the obvious one for us is NVIDIA. It just turns out that if you think a little bit about it, well, who holds the cards? Is it obvious that NVIDIA holds the cards and is going to make all the money? Not so much, because they're fighting for factory space at TSMC with Apple and Google. So TSMC can charge them whatever they want, and NVIDIA has no other choice but to pay. ASML, they now charge about a third of $1 billion for one of their machines, and where else are you going to get it? And this is reflected in performance. If you look at the U.S. market, where NVIDIA is a pretty big part, it was up about 11%, and that's the small, large, and so forth. That's a comprehensive measure of the U.S. market. Well, ASML is a very big part of the Dutch stock market, and the Dutch stock market for the first 6 months was up about 38%, 3 times as much as the U.S. market. And in Taiwan, TSMC is roughly the stock market in Taiwan, and that went up about 61%, the Taiwanese stock market. So it is important to know that there are benefits that investors had this particular 6 months, not from just from not being over concentrated in AI. And there was one value add that McMill added for you. The second, exposure to small and value. That's another benefit that you saw in these portfolios. And thirdly, it was the performance of international markets. Emerging markets was up about 23% 6 months. So all in all, Jared, a lot of great news to report, and I think it was just a quarter to celebrate a lot of these strategies that we've kind of talked about for very many years, and something that I know we share. And this 6 months were just played out really well. They panned out fantastically for investors.
Yeah, I agree. Appreciate the recap. Those individual stock comparisons really just points out why we get diversified, and why we don't focus on the individual stocks, because it's just tough. Warren Buffett admits it's tough. You're better off just getting the market as a broad index, and just get the winners and the losers, but in between you're getting that capitalism, and capitalism numbers have been great the last 10 plus years type of things. So yeah, we're definitely enjoying diversification. We're definitely enjoying having that international exposure, and the small companies have been doing great. So
Yep. And that's not to say that we're not paying attention. We're always paying attention to what's next.
right.
Interesting, because one of the big stories over the past few months has been AI, but also SpaceX. So is it worth touching a little bit on AI, SpaceX? Which one or both, or do you think it's kind of
Let's definitely go SpaceX. That's definitely been the hot topic. We
yeah,
got a lot of calls when SpaceX came out. Typical response was, realistically, it's probably going to shoot up, and then realistically, it's probably going to shoot down, and that's kind of exactly what we're seeing. So,
yeah,
maybe if you can talk about just IPOs in general, like what is an IPO?
yeah.
People read about that, and dive into SpaceX. Appreciate
Yep.
that.
So, I mean, first of all, what I found, Jared, and I travel the country, and it doesn't matter that I'm in the Midwest, I'm on the East Coast, West Coast, and the South. What I do find is that most people associate Tesla and SpaceX with Elon Musk.
Mhm.
And what I found is that he tends to be a polarizing figure. There are people who would run and get a Tesla just because they like Elon Musk, and others who would never buy a Tesla because it's Elon Musk.
Right.
So in that respect, I think that there is an undertone here that maybe some folks on the call might feel about Tesla and SpaceX being associated. In fact, funny enough, there's an ETF that is called QQQNE or something like that, which is like Nasdaq no Elon. There's an S&P no. So in other words, there's that element there, and I'm not here to talk about that. But I do want to start with something that I think it's universal, and I think ought to be accepted, which is that we need to celebrate entrepreneurship in this country. The fact that
Mhm.
somebody had this idea and started not one but two companies, and then we also have to celebrate companies that they just kind of became such important parts of the U.S. economy and the market. But secondly, the markets, the capital markets in the country that allowed for somebody like this to actually build these companies. So there's
Mhm.
a celebration here to be had about entrepreneurship and the system that we have in this country, because this could not have happened anywhere else in the world. This is only in America. So I think it's really remarkable. Now, when it comes to SpaceX in particular, and we talk about entrepreneurship, there's certainly some grand ambitions that this company has. And I think for the first thing that I would say is that every investor who wants to buy into any company, rather than do it because I like Elon or don't like Elon, or I like this person or don't like the idea, first read exactly what are you getting. And I think in this case, it might be worth just spending 2 minutes reading the very first paragraph of the mission of SpaceX that was put into the public filings. And we'll come back to a minute and what that means, because it kind of gives you an idea what exactly are you buying into. And it kind of says the first sentence in the disclosure form called S1 that's filed with the Securities and Exchange Commission. It says that our mission, again, this is the very first sentence, our mission is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. So if that's appealing to you, if that you think that's a good business idea, that's the future, absolutely buy into it. But that's what you're getting into. It's a very ambitious project that really hasn't been tested. We haven't really had life, not even on the moon. Forget about all the planets. But that's kind of the vision of this particular company. So it's a grand vision, and in some ways it has to be celebrated. But when it comes to investing in it, let's take some perspectives on how you invest in this vision. So SpaceX started as a private company. So Elon Musk put up some of his own money, and at some point he maybe tapped some of his friends from Silicon Valley and said, "Listen, you have a fund that invests in private companies. Why don't you give me some money so I can build this rocket?" So they might have put some money in. So originally you have a private company. And that private company starts again with maybe some Elon Musk, maybe bring in some other investors as they need to build rockets and hire engineers and so forth. And the company continues to grow as a private company. And along the way, as they attract more investors, the value at which they attract investors changes. So initially, maybe the company didn't have much; it was just an idea. So maybe the idea was worth $10 million. But as they built the first rocket and said, "Aha, maybe we can launch these things. Maybe now it's worth 100 million because we have some proof of concept." And the more they build the company privately, the bigger and bigger that number gets, because people see there is true value in what they're doing. So up until this point, Elon Musk controls basically who are the other owners into my business, because it's still a private business and you have control. McMill is that way. I can just walk in there and buy ownership. Jared would have to be nice enough to let me buy a piece of his business. And it might be the case with a lot of you folks on the line. Now, at some point, a company says, well, I need to actually raise more money from the public. I need to grow more. I don't have enough resources. And that could be one explanation. The other explanation is that, some of these initial investors, they want to get their money out. And, how do we do that? And the way to do that, either to increase the capital that they have to grow, or to cash out some of the existing private owners, one of the primary ways is to run something that's called an initial public offering. An initial public offering is that magical moment when a private company becomes public. And what it means by becoming public, they open up the ownership to the public at large. At that point, anybody can participate in its ownership. Elon Musk doesn't have any more control of who are the owners in that particular in this company, and that's what being public basically means. You buying ownership into a company that is no longer private, but now it's opened up the ownership to the public at large. Now, with that being said, it turns out that each company can decide how much of my ownership do I want to release to the public at large. And if you want to get an idea for what Elon Musk and SpaceX have done, and I want to double check, can you see my screen?
I can, yes.
Okay, so what they've done, if they said, okay, what we're going to do is think of the ownership piece as a big block of cheese. We're going to cut a slice, dangle it in front of these screaming fans, and toss it out for that feeding frenzy. And what they've done is they cut a really small slice, only 4.2% of the shares of ownership in SpaceX were released to the public. So very few shares, the supply incredibly limited. What about the rest of the 96% or so? Well, it turns out that there is something called a lockup period. And lockup period means that the existing shareholders who had shares while he was private, they can sell on the market. At the same time, there are some restrictions, and one of the primary restrictions is when. And in sometimes these lockup expires after a couple of months, after 3 months, 6 months, a year. There are different periods, and every shareholder might have a different lockup period. So initially, only 4% of shares are available, but the lockups, once they expire, more and more shares will become available on the market, and the percentage of shares available, it's called free float. So if you hear free float, is basically what percentage of the shares are available. Now, it's not unusual for an IPO to have a limited number of shares. In fact, if you look on average after a month, it's about 34%. About a third of the available shares are available. That's 34%. That's the average for a company going public. Elon Musk and SpaceX, it's only 4%. They really limited supply. They really wanted to create that feeding frenzy. And the more time goes by with IPOs, generally speaking, the more of these shares get released out of lockup, and the more and more they become available, to the point where a year later, roughly about 58% of all shares are now available for trade. And once you give it more time, if you look on average over the entire U.S. stock market, the 3,000 companies, the average of available shares is 96%. So the vast majority then become available for sale. And for SpaceX, the first consideration, folks, is that not only what you're buying Star Trek, you're buying the idea that we're going to live on Mars, and maybe we will one day, but that's never not something that was cleanly monetized previously. So it's a very ambitious idea. But secondly, is that you realize that if you're buying now, you are in that feeding frenzy. And when you look closer at the lockup expiration days for SpaceX, what you see is that by the end of September, 5 times as many shares will be available to the public because the lockups expired. So if you think of supply and demand, right now you have a very limited supply, you have a big demand, and just down the road, just a couple months from now, you're going to have tremendously more shares available. And the more time you give it, by the time you get to the end of the year, 10 times as many shares will be available as today. And a year down the road, roughly about half or 12 times as many as today will be available. So the first consideration is like, do you really want to go and get in that feeding frenzy? Do you want to fight for this very limited supply of shares today, or can you wait and let some of these let the supply increase a little bit before you try to buy some of these shares? So that's a decision that everybody makes, and we make our decision. You make your decision, but by and large, just the basic economics, supply and demand. Yeah, you could go right now and try to get SpaceX when it's very limited supply, but the more patient you are, it seems to me like the more likely is that you'll get a better deal. So that's the first thing. The second thing is that when you buy into a company, typically you want to see how much money is the company making. So I make an assessment on whether or not the price is a good deal or not. Let's think of your a business. If you're selling corn and oh, I'm making $100,000 a year, at least that's the earnings. So how much should I pay to get that profit of 100 grand a year? And that's the valuation of a business. In the case of SpaceX, they lost $8 or $9 billion last year, so there's no profit, and who knows when it's going to come. But you can value it looking at their assets. So in your case, if you have a business and you have some tractors, you have some land, and if you look at the value of those assets after you pay your loans, your liabilities, that accounting metric is called book value. So you can see how much are you paying to own these assets after you pay what's being owed on them. And in the U.S. market, that number is about 2.7. So if you wanted to buy $1 billion worth of assets after liabilities are paid, you would pay 2.7 billion. That's the ratio. That's called book to a price to book, price of the stock to book value, which is the stock price per $1 of company's book value. Now, if you look at IPOs, they tend to be a little bit more expensive. It's in the order of 6, so at least twice as much. In the case of SpaceX, it's actually tremendously more. It's 21.7. In other words, it's about 3 times greater than the average IPO, and 8 times greater than the market, 9 times greater than the market as a whole. So you are buying something that is relatively high priced or expensive, whatever word you want to use, and you got to be mindful of that. You're paying a lot. You're paying a lot to own this business, even with a limited supply. It's a very expensive proposition, and you got to be careful with that. So that's the second consideration. And thirdly, I think, Jared, if you look at the idea, should I own or should I not own? SpaceX will be part of the stock market universe in the US. The questions for you, number one, when do you want to buy it? Do you want to jump and get it right now? You can be flexible, and likely there's going to be a benefit in that. Number two is in what strategy? Because it might be part of the US market, but because it's so relatively high priced and expensive, it might not be worth buying into a value strategy, for example. So in what strategy do you want to buy it? And thirdly is how much do you want to own it relative to everything else out there? And that typically is based on what's called a free float, where we talked about the available shares. And right now, because the free float is so limited, even indices that have added SpaceX, they have it at a percentage, or actually 0.1%. It's a very low a percentage out of an overall fund. And we think it's, like you got to be careful, because if you buy index funds, for example, the committee makes the decision for you. And we do think that as a manager, we should control the decision, what we buy, when we buy it, rather than being told by a committee. So I think there is a benefit to having this flexibility and funds with some flexibility, rather than just kind of mindlessly flowing what a committee tells you to do.
That's the biggest thing that we see with, working with Dimensional is, Dimensional is not tied to a specific index. And we have the luxury of, just waiting out on the SpaceX and, letting it come back to reality, like Apollo's, showing just how expensive that stock is. So I really appreciate dumbing down SpaceX for us. So,
I mean, I think it's a very ambitious project.
right.
Uh, and it is Star Trek-ish. So if you want to believe, it's not the X-Files, I don't believe it.
Yeah.
But if you really buy into that vision, you also have to be careful with the monetization, because there's one thing to have this grand vision, and there's another thing to monetize it. So you have to pay attention to numbers, because you buy emotionally into this
Right.
idea. I want to be part of something big, and I heard it's great. Just dig a little bit deep. What exactly
Yeah.
are you buying? What's the
Right.
money behind it? Because that's what you're buying as a business owner. You're investing into a business. Is that a legitimately profitable business?
Right.
Um, and even if they say we're going to put all these things into space, like data centers, all that, none of that has been tried out. There's no precedent for that. So it is a high risk business, high risk, high reward
Yeah.
potentially. But how
Right.
much do you want to put your money into that?
Right. Yeah. Totally agree. Um, let's one more topic if we can.
Yeah,
And
absolutely.
I know, inflation's starting to kind of hit in the news, and they're talking about possibly raising rates maybe in September type of thing. Can you just kind of tell us a little bit about maybe what the market's telling us, and a little bit about rates and how rates, once again, affects savers, in a positive way, affects, borrowers in a negative way, I guess. So if you can kind of just touch on that, because that's probably going to be hitting the news next quarter.
Yep, yep. So a lot of this has been tied into the Fed, and what's the Fed going to do, and all that. And is it worth touching on the Fed, or just go straight to interest rates?
Yeah, I think we've touched on the Fed in the past.
Okay.
Let's go into the interest rates
So
if you can.
here's the way that I would think about this. That a lot of the discussion around the interest rates is around the Fed, but it's not all about the Fed. So let's demystify exactly and see what we're talking about here. So if I were to look at interest rates, what exactly are interest rates? Well, interest rates, where they come from, is the fact that, let's say, the U.S. government wants to borrow money. They don't go to a bank. No bank is big enough to accommodate. But rather, what they do is they come to us as investors and they say, listen, if you are willing to lend me $1,000, we will write up a contract, and in that contract, we will specify an interest rate that you get for that money, and for how long you get that interest rate before I pay you back the principal. We call it a day, we go home, and that is called a bond. So a lot of interest rates that you see out there, they come from these bonds, because these bonds are primarily dictating the rates that we all pay. So when you think about bonds, quite often, by the way, can you see my screen?
Yes, we can.
So when you think of these interest rates, it turns out there's not a single interest rate in the U.S. market, and the length of the contract plays a really important role. And the length of the contract typically is also called maturity. That's when the contract matures and everybody goes home, and that's the technical term, maturity. Which is, what's the length of the contract? For how long do you get the interest rate before you get a principal back and we all go home? And that is, in fact, been shown to be related to the interest rate that you receive as an investor. So, for example, if you give the U.S. government your money for 30 days, and after 30 days you get your money back plus interest, the interest rate that you would get, it's relatively low because you're dealing with the government. In a month, you get your money back, so it's quite a quick turnaround. So there's not that much uncertainty associated with that. But if you're now willing to give the government the money for a year, well, the money's there for a little bit longer. So investors historically, when you look at data, they've kind of asked for a higher rate, which kind of makes intuitive sense. If you look at 5 years, the investors have said, my money's locked up for longer. You got to pay me a little bit more to keep my money for longer. And so was the case 10 to 20 years, you get an even higher rate. So there's clearly been shown in the data, there's this relationship between the length of the contract, the maturity, what's called, and the interest rate. So now coming back to this question at hand, what's going to happen now? Well, it turns out that the Federal Reserve, which we all pay attention so much to, it really is looking at specifically these short-term rates, these 30 days and even less than that. If you want to make payroll, you need to take an overnight loan. That's the interest rate that they control. And those interest rates are reflected in certificate of deposits at the bank, because those certificate of deposit, they have to buy very short-term instruments like this. So that's where you see the Fed making the biggest impact in this range of very short-term rates. So the Fed, what it's trying to do, it basically balanced two competing mandates that they have. So in 1979, they were given two mandates. One is you have to keep prices under control. We don't want to just have runaway inflation. And number two, we want to have the economy humming. So make sure there's good economic activity. And sometimes the two are at odds with each other. But that's what the Fed is trying to do, is take these two competing mandates and try to do the best, given that primarily they control the 30 days. So this year, last year, when the economy was seemingly slowing down, the thing to do is to promote economic growth. And the way you do it is by saying, hey, why don't I make it cheaper for companies and individuals to borrow at these very short-term rates? And I do that by cutting interest rates. And by cutting interest rates, I promote economic production. Now, as you promote economic production, you also might stir up inflation. And they didn't do much last year. And this year, what happened was because of the war in Iran, because of AI, because of a variety of things, prices started to go up. And now the Fed is in a bind. The Fed is saying, well, if I raise rates, that might hurt the economy, but it slows down inflation. So this year they've kind of said, let's wait to see what happens. So a lot of the decisions that the Fed are making are to control one of these two variables. Now, this week, the Fed chairman went on TV and in front of the Senate and basically said something very clearly. Between the two mandates, we do prioritize inflation. So if inflation stays higher as it is right now, above the target that they have, it is unlikely for them to cut it because again, their main job is to control inflation, and it wouldn't be something that they would necessarily do. So do I expect rate cuts on the short end? It depends on inflation. If the inflation cools down, maybe. It's just unlikely. It is just very unlikely with the inflation staying as high as it is, because then the Fed would just kind of shoot themselves in the foot, and doesn't appear that they want to do that. Now, there's also the inflation that impacts these long-term rates, and this is where it's really interesting. And to see that, we can look, for example, at the first 6 months out of this year. And for the first 6 months, Jared, the Fed did not make any changes to the rate that they primarily control. It's been pretty much flat. And that's because, again, they're trying to balance the potential risk of inflation with hurting the economy. So they just said, let's just wait and see. Now, these rates, you look at the 10-year interest rates, it turns out that they did fluctuate quite a bit, even as the Fed made no moves. And if you look between kind of March here and May, at some point we had an increase of 0.7% in rates for these 10-year, even as the Fed made no moves. Why is that? Well, it is also caused by inflation. Because if I were to lend my money for a number of years down the road and I see inflation picking up, well, I want to make that up. I at least want to be able to buy the same things. So as expected inflation goes up, investors demand a higher rate on these longer term bonds. And that is one of the reasons, one of the primary reasons why we saw these 10-year increase was because the expected inflation over the next few years also increased. And that's typically the pattern. Expected inflation goes up, so the interest rates at the long end, even though the Fed made no moves. There are other reasons like, how much is the government borrowing, and the risk associated with the Fed. So there are a lot of other variables, but to me, the primary one is the expected inflation. And that went up because of the war. So the war didn't just have a direct impact on the gas pump and maybe groceries and on your business, but it also impacted the inflation impacted these longer term rates. And I have to say, if you look at the long term 10-year treasury, which is the interest rate on these longer term bonds, and then you overlay on top of that the mortgage rate, you do see they're clearly connected. They're clearly connected. In fact, the 10-year forms the baseline for the mortgage rate. So this is where it gets so interesting: is that the 10-year the inflation that we experienced this year doesn't only have an immediate impact at the gas pump or the grocery store, it also has a long term impact because these mortgage rates moved up with the expected inflation. And that's why inflation is such a horrible thing. So long story short here, we've had this potential for inflation, and the Fed is really trying to do its best. And this thing that I'll have to tell you folks is that the biggest thing is how people perceive the Fed to be. If they perceive the Fed to be weak and caving into political pressure and maybe cutting rates at a time when inflation is not under control, the expectations that market participants, businesses have is that, boy, we're going to have high inflation because the Fed is not serious about fighting it. That's exactly what we had in the 70s when President Nixon. And the problem was that if you're a union negotiating a contract over the next 5 years and you expect inflation to stay high because the Fed is not serious, you're going to bake that into a contract, and then inflation becomes a self-fulfilling prophecy. And that's what happened up until 1979 when a new Fed chairman came along. His name was Paul Volcker, and he said, "No more monkeying around. We're going to be fiercely independent, and we're going to make sure that people perceive the Fed as being independent and making the right calls." So that's at the moment that we're in right now. The Fed is in a bit of a bind because if they start lowering rates as inflation stays high, it's going to be perceived as very weak and politically influenced, and that's going to have really bad repercussions for you, not only today and tomorrow, but over years and years and years if you get a mortgage and you pay these high rates because of people not believing that the Fed is serious. So that's why it's crucial for the Fed to maintain its credibility. And if it says we're going to fight inflation, they might have to either stay with the rates that we are right now or even increase the rates to show that we're really careful.
Yeah. Well, it's something to watch. I guess they meet in September. Is that right? When the Feds meet?
Yeah, but don't read too much because that particular decision will not impact likely your mortgage rates. The mortgage rates are
Mm-hmm.
driven by the other factors. If you look at a lot of other rates in the economy, they're not driven by the Fed. And I think there's the myth that the Fed is all powerful, controlling every rate. They control certain rates, and
Right.
I'm not saying they're not important, but there are a lot of others. And even the decisions they made, it is put in the context of what happened in the past. And even if they say we're going to cut rates, instead of celebrating, you might actually find that this is going to hurt you in the long run.
Mm-hmm. Yeah. And that goes back to why we stay diversified, because you don't know what's going to happen in September. Even if something did happen in September, to your point, the market kind of bounces its own way depending on other factors in the news. And to collectively know all of that is it's an impossible game, and that's why you just have to stay diversified no matter what you do, and
And
focus
the
on
market,
rebound.
absolutely, that's the best
Yeah,
strategy.
yeah. Well, with that, I think we hit everything from the market review to all the way to SpaceX to a little bit about the Feds. And I love your background. It looks like you're at SpaceX headquarters right now.
Well, you're talking to a guy named Apollo. I should have been.
All right. Yeah, Apollo. So with that, I'm going to go ahead and close the webinar. And as always, we appreciate your time, and we know you're busy. And we really appreciate you making these headlines simple for us so that our clients can definitely understand it. So with that, thank you, and I'll go ahead and close.
Bye-bye.
Goodbye.